In 1995, Nick Leeson, a 28-year-old trader at Barings Bank, seemed unstoppable.
Like many in the 1980s, Nick Leeson wanted to be rich and successful. But Nick Leeson was also a very strange man.
His colleagues whispered about his golden touch, amazed as he generated millions in profits from the bank's Singapore office. Management celebrated him as their star performer, never questioning how one man could consistently beat the market. But behind the facade lurked a devastating secret. Leeson wasn't a trading genius. He was desperately hiding catastrophic losses in a secret 88888 error account, doubling down on risky futures contracts like a gambling addict convinced the next bet would save him. He bet everything on Japanese markets staying stable. Then, on January 17th, 1995, the Kobe earthquake hit. Within hours, his house of cards collapsed. The losses, a staggering £827 million, about $1.3 billion, instantly vaporizing Britain's oldest merchant bank after 233 years of operation. One man's reckless trading had destroyed an institution that survived world wars and the Great Depression. This nightmare scenario isn't just history. It's repeating right now in the accounts of everyday investors who don't recognize the warning signs. Of course, with minor but devastating consequences. A wrong investment can tear apart a lifetime of investments. That's why, in today's video, I'll rip away the curtain on the financial industry's most dangerous traps, and after that, teach you how to choose good assets. And please don't forget to like and subscribe, okay? That's it. Let's dive in. All right, first up, cryptocurrencies with unclear purposes or projects behind them. You might remember the Trump official coin. It actually caught a lot of people's attention when it launched. Initially priced at around $28 per coin, plenty of investors thought it was a good bet. After all, it had the branding, it had the buzz, it had everything except one crucial detail, a clear purpose or legitimate project behind it. This kind of crypto usually rides a wave of excitement and speculation. People jump in hoping for big returns without really understanding what they're investing in. But when the hype fades and the market realizes there's no solid foundation, the price inevitably falls. Let's use a real mathematical example with the Trump official coin to illustrate this clearly. Imagine you invested $2,800 when the coin first launched at $28 each. That would give you exactly 100 coins. Fast forward to today, and let's say the hype has faded. Now the coin is valued at just $12.90 each. Here's the calculation. Your initial investment, $2,800, 100 coins times $28 each. Today's value, 100 coins times $12.90 each. So $1,290. This means your investment dropped from $2,800 to $1,290. You lost $1,510, or roughly 54% of your initial investment. Now here's why losing money hurts so much and why recovery is incredibly challenging. When you lose money, your remaining investment is smaller. This means you need an even bigger gain, percentage-wise, just to get back to your original amount. Think about it. Lose 54% of your money, as in this case, you now need a gain of about 117% just to break even. Lose 50%, you now only have half left. To get back to your starting point, you can't just earn 50%, you have to double what's left, meaning you actually need a 100% gain just to break even. I don't know if you understood this by now, but that's because 100% of $50 is $50 and 50% of $100 is $50. Another example, lose 80%. Now you're left with only 20% of your initial investment. To recover from this huge loss, you'd have to multiply what's left by 5, requiring a 400% gain. That's why losses hurt so badly and why reckless investments, especially cryptos based purely on hype, can cost you so much. Before investing, always ask yourself, does this crypto solve a genuine problem, or am I just buying hype like Bitcoin solves a genuine problem? If you watched one of my last videos, you know this. So is worth it. I think you get the idea. Okay, now we can move to the second topic, assets with a lot of fees. Imagine you're investing in an asset that seems promising. Steady returns, solid reputation, and everyone says it's a smart choice. But here's the catch. Hidden beneath the surface are layers and layers of fees, slowly draining your returns without you even noticing. High fees can quietly eat away your profits. And the worst part is that many investors don't realize this until years down the road. We're talking about assets like actively managed mutual funds, investment-linked insurance plans, and certain complex investment products sold by banks or brokers. Let me give you real-world examples. Take the Fidelity Magellan Fund, FMA, a popular actively managed mutual fund. With an expense ratio of around 0.47%, it seems relatively modest compared to other active funds, but still significantly higher than low-fee index funds. And crucially, actively managed funds like this rarely match the long-term market performance. In contrast, consider a low-fee index fund like the Vanguard S&P 500 500 ETF, VOO. It simply tracks the market, requires minimal management, and charges an expense ratio of just 0.03%. Over decades, this seemingly small difference in fees, alongside better market-aligned performance, can compound into hundreds of thousands of dollars more in your pocket. Let's clarify this mathematically, considering both realistic returns and fees. But of course, it's just a hypothesis. I'm not going to use 100% real values here, nor have maximum precision. I'm just approximating so you can see the difference these fees make in the final amount. Suppose you invest $10,000 per year for 30 years. Actively managed funds, after fees, typically underperform, averaging around 7.5% annually. Passive index funds consistently track the market and historically return around 10% annually, minus minimal fees, leaving about 9.97% annually. Here's how the numbers look. In an actively managed fund after 30 years, your investment would be approximately $1,031,000. In a passive index fund after 30 years, your investment would grow to about $1,635,000. This means that over 30 years, choosing the passive, low-fee investment would leave you with about $604,000 more, simply by avoiding excessive fees and the common underperformance of actively managed funds. Always look carefully at the fee structure and historical performance before investing. Because, trust me, small fees today and modest underperformance can cost you an enormous amount of money down the line.
The third topic is structured notes. On paper, structured notes might sound attractive. Downside protection, market participation, fancy terms that brokers love to pitch. But let's unpack the reality behind these products. First, structured notes expose you directly to credit risk. You're not just investing in a stock market strategy. You're relying entirely on the financial strength of the issuing bank. If the issuing institution runs into financial trouble, like Lehman Brothers did in 2008, you could lose most or even all of your investment overnight. According to the SEC, structured notes are considered unsecured debt obligations. You're basically lending your money to the bank, hoping they'll stay afloat.
Would you seriously risk a substantial portion of your life savings on the financial health of a single, highly leveraged institution?
Second, structured notes come loaded with hidden fees, commissions, and spreads. Banks typically bake in costs ranging from 2% to 5% or even higher, according to FINRA, the Financial Industry Regulatory Authority. And these fees are not clearly disclosed up front. Would you personally ever invest your money in something without fully understanding what you're paying in fees and commissions? Transparency matters, and structured notes rarely deliver it. Third, structured notes are often extremely illiquid. FINRA specifically warns investors about liquidity risks associated with structured products. Once you're in, your money might be trapped for years, and selling early usually means steep penalties or losses exactly at the moment when you might urgently need access to your capital. Fourth, structured notes frequently offer unfavorable tax treatments. According to the IRS, many structured notes generate ordinary income or short-term capital gains, meaning you could face significantly higher taxes compared to long-term capital gains from simpler equity investments or ETFs. Fifth, structured notes can be callable at precisely the wrong times. This means the issuer has the right to redeem the note early when it suits their interests, not yours. If markets move favorably, you lose future potential gains because the bank calls back the note. When markets perform poorly, you're stuck holding the note as it falls in value. Sixth, and this one's a real deal breaker, the underlying indexes typically used are price indexes rather than total return indexes. The SEC clearly points out that price indexes do not factor in dividends. Historically, dividends have accounted for approximately 40% of the total returns of equity markets over the last century, according to S&P Dow Jones indices. The banks essentially pocket your dividend yield and use it to finance their options strategies, robbing you of critical income and growth potential. Finally, let's state the obvious. Banks design these products because they profit from them. According to a study by Securities Litigation and Consulting Group, structured products are intentionally complex and designed to favor issuers, not investors. Why would you willingly place yourself on the losing end of a trade created by people with better information, more resources, and higher sophistication? Bottom line, structured notes are a complicated, costly, and risky investment that most investors don't understand, and frankly, don't need. The SEC, FINRA, and countless financial advisors warn investors to be cautious of structured products, noting they rarely deliver meaningful advantages over simpler, lower-cost investments. Remember this clearly. The guy pitching you structured notes isn't acting like a fiduciary advisor. He's a broker selling products, often products neither he nor his clients truly understand. Stick to investments you know, understand,
and can rely on.
The fourth thing promises with miraculous return. Come on, guys. This will be very quick and simple. You know those investments that promise 10% per month and things like that regularly? You can't even call that an investment. Just use basic math. If you invested $100 every month in an investment with a 10% monthly return, you would have $9,454,465,575,634.16 at the end. In other words, it's impossible, or someone is accumulating trillions of dollars out there and waiting to reveal it. Seriously, no investment that is completely tempting, that defies math, is real. Okay, some investment can make 10% in a month or even much more, but it won't stay that way forever. It will definitely fall and return to the average. Anyone who promises a high and regular return is lying to you.
Now, coming to the conclusion of this video, let me teach you how to choose good assets. First, never put a cent into something you don't understand. Choosing good investments isn't about chasing the latest trends. It's about clarity and logic. So how do you do it? Step 1. You must clearly understand what the asset does and how it makes money. For example, Apple sells products and services people love. Simple. Coca-Cola sells beverages globally. Clear. Bitcoin offers digital scarcity. Straightforward. Step 2. Always consider the fees and costs involved. A seemingly small fee can drastically reduce your returns over time. Good assets are cost effective. Step 3. Good assets have clearly defined risks. If you can't easily understand what can go wrong, steer clear. Step 4. Choose assets with good liquidity, meaning you can buy and sell quickly without penalties or huge spreads. Well, that's it, cousins. Stay invested until the next video.